Understanding Japan's economic struggles and the yen's decline. Are you fascinated by global economies and the twists in their financial journeys? In today's video, we're diving deep into Japan's economic struggles, unraveling the mystery behind the yen's dramatic decline. Why has one of the world's largest economies faced decades of stagnation? And what lies ahead for the land of the rising sun? Stay tuned as we break it down for you in an engaging and easy-to-follow way. Economists often summarize economies as developed, developing, Argentina, and then Japan. This tongue-in-cheek observation points to Japan as a unique case, a nation that, despite technological advancement and a strong industrial base, has been stuck in economic limbo for over 30 years. Today, Japan grapples with a declining currency, the yen, which recently hit a 34-year low of 160 per US dollar. For a nation dependent on imports, this poses a serious challenge. Japan imports over 90% of its energy and more than 60% of its food. A weakened yen has caused inflation, a phenomenon not seen significantly in Japan for decades, to rise sharply. Yet Japan's approach to addressing currency stabilization is unlike that of many countries. Here's why: years of ultra-loose monetary policies have left Japan with record debts. This unique predicament forces Japan to rethink how it can stabilize the yen. But how did Japan arrive at this crisis point? For that, we need to take a trip back to the early 1990s. Following its defeat in World War II, Japan rose like a phoenix. From 1955 to 1990, its economy grew at an astonishing rate. GDP multiplied eightfold, earning this period the title, the Japanese Miracle. With unmatched technological advancements, Japan soon became a global economic superpower. It was even predicted by some to surpass the US economy by the early 2000s. However, prosperity brought tension. US-Japan trade rivalry escalated during the 1980s, mirroring today's US-China competition. Accusations flew about Japan stealing American jobs. But all these fears about Japan's dominance evaporated in the 1990s when its economy came crashing down. In the late 1980s, Japan experienced an aggressive asset bubble. Real estate prices soared, and the stock market hit astronomical highs. But in 1990, the bubble burst. Residential property prices dropped by over 50% in the following years. Commercial property values fell a jaw-dropping 85%. The Nikkei 225 stock index plunged a staggering 75%. The crash marked the start of Japan's infamous lost decades, a period characterized by sluggish growth and near-zero inflation, leading Japan to earn the moniker the land of permanent recession. What prolonged Japan's economic struggles? Economists point to a unique phenomenon called a balance sheet recession. During the financial boom, businesses and households borrowed heavily. When the bubble popped, everyone prioritized paying off their debts over spending or investing. This undermined traditional measures, such as lowering interest rates, to stimulate growth. In typical economic slumps, when interest rates fall, businesses and individuals borrow money to take advantage of cheaper credit, driving new investments and consumer spending. But for Japan, debt hangovers from the 1990 crisis meant that no one wanted to borrow money, not even at interest rates close to zero. This phenomenon trapped Japan's economy in a vicious cycle of stagnation and weak demand. Worse, deflation, the decline in overall prices, became an unwelcome guest. Though deflation may sound positive since products cost less, it discourages spending. If prices continually decrease, why buy now when things will be cheaper tomorrow? This vicious cycle dragged Japan into decades of minimal growth, while the rest of the world surged ahead. The Bank of Japan, BOJ, Japan's central bank, embarked on experimental monetary policies to break its economic stagnation. Among the boldest measures were quantitative easing, QE. The BOJ launched massive asset purchase programs to pump money into the economy. This included buying government and corporate debt to keep interest rates ultra-low. Yield curve control, YCC. Between 2016 and 2023, the BOJ capped interest rates by buying unlimited quantities of government bonds. While these measures injected liquidity into the economy, they ballooned Japan's debt. Today, Japan's debt-to-GDP ratio exceeds 260%, the highest among developed economies. This debt mountain limits how flexible Japan can be in addressing economic shocks, like the yen's recent collapse. The yen's dramatic fall against the dollar and other global currencies is a direct result of diverging policies among major central banks. Inflation surged worldwide in 2022, prompting aggressive rate hikes in the US, Europe, and beyond. This made their currencies more attractive for investors seeking higher returns. In contrast, Japan hesitated to raise interest rates, fearing that it could make its towering debt unmanageable and crush domestic industries reliant on cheap financing. This widened the yield gap, pushing investors to abandon the yen and sending it plummeting from 130 to 160 against the US dollar, its lowest level since 1990. The yen's depreciation is a double-edged sword. On one hand, a weaker yen makes Japanese exports cheaper and more competitive globally. On the other, it drives up costs for essential imports like energy and food, fueling inflation. Japanese households now face higher living costs, and government debt repayment costs could escalate dramatically if interest rates rise. To address the yen's collapse, the Japanese government intervened in currency markets, spending billions of dollars from its hefty foreign exchange reserves. While this has provided short-term relief, it's an unsustainable long-term solution. The BOJ now grapples with an impossible choice. Leave interest rates low to protect the fragile economy and risk further yen depreciation. Raise interest rates to contain inflation and stabilize the yen but risk triggering a fiscal crisis due to Japan's massive debt levels. In 2024, the BOJ made history by raising rates for the first time in 17 years. This pivotal moment highlights the struggle to balance economic priorities. But will Japan's economy withstand more hikes? The future of Japan's economy and the yen hinges on global economic trends. If inflation declines and other central banks slash interest rates, the pressure on the yen may ease. However, if inflation persists, Japan could find itself under relentless financial strain. One thing is clear: Japan cannot rely indefinitely on its foreign reserves to prop up the yen. Sooner or later, decisive action will be unavoidable. Whether it accepts a permanently weaker yen or risks a financial crisis by raising rates further, Japan faces no easy answers. For decades, Japan has been a cautionary tale for economic strategies gone awry. Yet its tech savviness, innovation, and resilience remind us of its underrated strengths. Will Japan emerge as a global example of economic recovery? Or will its struggles drag on? Let us know your thoughts in the comments. Will the land of the rising sun rewrite its economic story? Don't forget to like, share, and subscribe for more insightful breakdowns of global issues. Stay informed, and we'll see you in the next video.